Hello, and welcome back to another episode of Rise and Shine, where we spotlight the sharpest mind in real estate investing. And I am Irismar.
I'm Jim.
And together we are here and excited to delve into the financial intricacies that every real estate investor needs to master.
Absolutely, Irismar. And today we are thrilled to have Scott Dillingham from LendCity Mortgages with us. And Scott is a standout figure in the mortgage industry, and he's known for his innovative approach to financing and his commitment to helping investors maximize their potential.
And with a keen understanding of the mortgages landscape and a forward-thinking mindset, Scott has developed strategies that assist investors in navigating through the complexities of acquisition and property financing. His expertise is particularly valuable today in ever-evolving market conditions.
Yeah, absolutely. So whether you're looking to refine your financing strategies, understand the latest mortgage trends, which there was some big announcements today, or simply getting a leg up in the real estate game, Scott will provide you with the tools you need.
So without further ado, let's welcome Scott Dillingham to Rise and Shine.
Yes, and thank you. And I'm looking forward to that because Scott's actually located in Detroit. Welcome, Scott. I mean, he's in Windsor.
Ontario, not Detroit.
Very close to Detroit.
Right across from Detroit. Yes. How are you guys?
We're doing great. Thank you so much for joining us.
Awesome. Yeah. Thank you for having me. I'm really excited.
Now, Scott, I don't know if you're aware of the news. There's been some ripples in the news today for real estate investors about the government making some changes to the affordability housing crisis that we're having, or lack of affordability, I guess, that we're talking about. I don't know if these changes are, I haven't had a chance to go through them. It was an afternoon release. I'm not sure, and I'm kind of putting you on the spot here. I apologize. I don't know if you're aware of anything that has come out.
Yeah. So, I don't know if anything came out today, but if something did, then I intentionally ignored it because yesterday, here's what they did. So they're saying, homeowners are having the hardest time paying their mortgages, and we want to do something to help them. So you know what they did? They extended the amortization for mortgages to 30 years for first-time homebuyers. Now, here's the catch. So you think, okay, that sounds really good, but they only offered it on new construction properties, on new homes. And I got to tell you, I say so I've been doing this 12 plus years. I think I might have had one person or two that was a first-time home buyer buy a new home. That's usually what they work up to. You know what I mean? They'll buy something small that they can afford, they'll upgrade it, they'll sell it, and then they'll move into their dream home. So I don't think this is going to help anybody. And I think the move was completely political. And if I'm not around in a week, it's because they assassinated me for saying so. Because, yeah, it's crazy. But yeah, I'm telling you, it's fully political. It's not going to help anybody.
Well, let's not get carried away because you're far too valuable to the investor.
Yeah.
We need you, Scott. Please stay here and stay safe. Now,
Yeah.
sorry, were you going to say something?
No, no.
Oh, yeah. Well, I feel like all levels of government right now are just are putting a lot. And I don't like getting into political discussions, but I think there's just a lot of things that are being thrown out there, and really nothing is really from all levels of all types of government. Nothing is really doing it. But the strange thing is during all this noise and all this, investors are still buying.
Yeah, they sure are. They sure are. I think they went on the sidelines when the rates started to go up, right? Because it was harder for properties to cash flow. But the rates have started to come down in regards to the fixed rates, right? So the Bank of Canada is controlling the variable right now, but the bond market controls the fixed rates. And they've come down a lot. Like in November, for an owner-occupied home, rates were around 6. And that's just November. Now you can get something under 5. So, and that was just from the bond market, right? So no government intervention. So people know that rates are cheaper now, and they're getting out there, whether they're a homeowner or an investor. Yeah.
Excellent. And now, as we said, as we started off the program, Scott is in Windsor. I think you're born and raised Windsorite?
Well, actually, no. So I do live here most of my life, but I was actually born in the States.
Oh.
And we moved here when I was 5. And that's kind of how I was able to get my foot in the door and do the US lending, is because I'm also American.
Beautiful. I love that. And that's a huge benefit because a lot of Canadians, especially in Ontario and often BC, they're having trouble finding the cash flow properties here and they're looking towards the US.
Absolutely. It's happening more and more and more. We've been educating a lot of investors about it. In fact, that's how we met, right? Is I was invited to speak at an event about this specific topic, and you guys were there, and we had a lot of fun. But that's it. Yeah, it's not like see you later, Canada. And I know they mentioned that at the event too. It's not that. It's just we want more options, right? Because if we can't find something that makes money in Ontario the way that we need it to justify moving forward, right? Where else can we go? And yeah, there's other places in Canada, but then you have different regulations too that maybe don't make that investment attractive. So then investors are like, okay, look at the States. And there's even other countries that they're looking at too. But I find the States is the most common because it's the most like our economy.
Absolutely. Yeah, they're our big brother to the south. But just staying on this side of the border for a moment, keeping our toes cold. What do you see investors getting into now that rates have a little bit dripped on the fixed mortgage side? What do you see investors getting themselves into?
Like as far as like mortgage product or investor product?
Invest
Okay, so I'm seeing people there's a bunch of different things, right? You're seeing Airbnb friendly markets. A lot of people are really after that product, okay, because you can still have solid cash flow with Airbnb, but they're obviously being careful because certain towns and areas are banning Airbnbs, right? You do have to be very careful with that. We are seeing not as much as we had pre-COVID, but we're seeing a lot more investors focus on student rentals as well, because again, they want that cash flow. We're seeing more multifamily transactions too, because you used to be able to buy a single family house, in many areas in Ontario, and you could make it cash flow with just one rent, but it's much harder now. So we're seeing more towards the multifamily as well. And that's only residential, right? Obviously, commercial is a little bit different. Commercial, I find, is really tough right now because these sellers want to get that top tier property, but their rents are well below market. And so the lending institutions lend based on rents. So if it's an older building, those are harder to finance right now.
Well, and as we saw, Irismar and I just had on our show a little while ago, we had Sarah Lardy
Yes, Sarah
and
Larby.
Aisha Govani, and they were short-term rental geniuses, and they really did great things in the short-term rental space. The market got very saturated in Ontario with that, and they've learned to switch to the MTR, medium-term rental.
Yeah.
That's been a big win for them. Are you seeing much of that in the greater Windsor area?
Yeah, I've even done some myself over the history of my investing. So there's a few companies, and they'll like you obviously furnish the property. So it's great for those Airbnb properties that maybe the bands came out and they can't, have Airbnbs hosted there. But, and I don't want to promote them on here. I'll share them with you guys after the fact or whatever, but they rent to executives who pay 2 to 3 times what a single family rent would be, and they cover everything. So like I had the one tenants, they were from China, and they just different materials in the kitchen. So they put the hot pan on the countertop and it kind of ruined that area, like it burnt a spot there. And the employer completely paid to have a brand new countertop. So it's like they're covering repairs and maintenance. They're paying 2 to 3 times higher rents than single family. So it's really cool. And they're renting 3 months to a year, depending. And the reason why this product is important is because infrastructure projects or new things going on in different areas, they might need a specialized engineer or someone unique, right? A project manager, right? And so they don't want to stay in a hotel. They'd rather live in a nice home, right? And have those luxuries. So we are seeing a lot of that, and I've personally done that myself, and it's worked out really well.
It's awesome. Really happy, really congratulations. Now, in terms of the STRs though, I think I've heard BMO has some investor-friendly mortgage options lately. Can you tell us a little bit about those?
Yeah. So we have BMO. There's a few other lenders too. Desjardins pretty good with it as well. Where they will openly do Airbnbs. Like you don't have to like hide it, because investors come and they try to hide it, and we're like, guys, like why? You don't even have to. But yes, they will openly do the Airbnbs. And so that's a great product. It does depend on the area though. They are kind of particular on location. But yes, they do it. So it's not hard to get financing. And even if you're an investor who has many properties and you can't, say BMO or Desjardins says, sorry, you have too many properties, we can still do that very same product on commercial. So a lot of people think with commercial lending, it's like apartment buildings. And for the most part it is, but there's commercial lenders that will do small projects like this, and they'll use the Airbnb income, they'll use the student income, and you move the deal along. So we can go commercial too.
Right.
It's
And is
pretty
that
cool. A lot of people don't know that.
that like in terms of you started off saying that there was multiple properties and they won't give any more lending. So are they doing kind of like a blanket mortgage on all the properties then, or how are they looking?
No, but what I mean is like, so say for an example, and I know the banks are funny with me giving out their policies online, so I won't say the lender, but the one lender will let you have 10 properties, but only 5 can have mortgages on them, as an example. Okay, so let's say this would be your 6th property with a mortgage. That lender will say, no, we can't move forward. So you're hitting these caps. So on commercial, for the most part, the caps kind of disappear and they'll continue you to grow. And the rates there a little bit higher, and there is fees on commercial where there's not fees, if the broker's getting paid from the lender directly. So that's a bit of a negative, but then those rules disappear.
It's very good to know. Yeah, absolutely. Now, Windsor area, the greater Windsor area has some really nice opportunities for short-term rentals along the waterfront there. It's beautiful. The municipalities there, have they been turning down the STR, cutting them down, or what's going on?
Yeah, some of our local areas are absolutely cutting down. Some it's completely banned. Some there's additional licensing requirements now. So it's definitely harder. Yeah, they're cracking down on it for sure.
Do you have any insight? I mean, Airbnb came and disrupted a lot of small towns.
Yep.
Disrupted cottage country. And municipalities have come back because of the residents, and they've completely shut it out. Do you have any insight, or do you feel like there ever is going to come to be a time where there's some common ground in these types of properties?
I mean, maybe, but the thing is just kind of like when we talked about the amortizations at the beginning of this interview, it's just like the solution is not banning Airbnbs to create more housing. That's not the solution. The solution is to open up development and not have so much red tape with development and have all these crazy fees that developers have to pay. So where I live, there's many little small towns beside us, and Windsor has a huge fee just to even put a shovel in the ground compared to the neighboring city. So, right, those things are weird, right? So it's getting rid of that. And like, for an example, the government, they announced all this money that they're giving out, especially in Ontario, right? I think it's actually just Ontario. I think it's something almost $1 billion to develop properties, but not for single family. It's only for multifamily. Do you know what I mean? So I know they're trying to make more density, but there's still lots of ground. There's still lots of areas where single family homes could be built. So it's just when you have so much rules on everything that you're doing, people get discouraged and they stop. So CMHC just released their housing report. I believe it was last week. You can check it out. They expect housing builds to go down next year. We need them to go up. And they're expecting that less houses are going to be built next year than this year. And it's the red tape, it's the regulation, right? So if we really need more units, they should focus on that. And then that will fix the problem, not saying, oh, Airbnbs are bad. You shouldn't have that. So that's my thought.
I mean, I think we can go down a total rabbit hole here, and I'm trying to keep focused, but I mean, yeah, it sounds like the landscape of real estate development in Ontario, especially Ontario, is really going to be very different in the next decade. In terms of, you know, we're building more multis than we are single families. That's changing the landscape very much.
Yeah.
You know, single family homes were very prominent in many neighborhoods that dot the streets of these major urban cities. And you know, you've got about 4 or 5 strong families in Ontario that pretty much control the housing development as well. So it's certainly a rabbit hole that we can go down and get lost in. Maybe we'll stick to mortgages and what are opportunities for the states. And also I want to talk a little bit about you know, what we were saying earlier was how Canadians can invest
Yes.
in the states as well.
Yeah. So where would you like me to start?
Well, what does it look like? I mean, here we are in Ontario, we're having trouble finding cash flow, and we hear so much about the states. We hear about Detroit and Ohio, especially. They're right there. A lot of people, a lot of Canadians walking there. What's that look like for a Canadian investor to enter those types of markets?
Yeah, it's actually super easy. And for me, it's kind of like a breath of fresh air, right? Because every year that I've done mortgages in Canada, it's actually got more and more difficult because there's more and more regulation. Then they introduced the stress test, right? So then that happened. And first it was just conventional, and then it went to also insured, and they cut back the amortizations. And so it just year over year, it's just getting tougher, right? So in the States, it's just so easy. So I love it. But really it starts with setting up an entity over there. Okay, so you want to speak to an expert to set up the entity. Now, I'm not a tax professional, so I can't give any tax advice, but I know if you don't do it correctly, that you could be double taxed from both the states, and you could be taxed in Canada. Okay, so this is why you got to speak to an expert for taxes. So they'll set you up. So you're just paying one tax, because Canada and US, they actually have a treaty where they recognize the tax that you pay in the other country. And so if it meets the threshold of what they would be billing, then they're not going to charge you tax in the other country. Okay, so that's where an entity is useful. Now, most of these lenders, anyways, want you to have an entity. There's a handful that you can buy in your personal name, but the rates and the fees are a little bit higher. But pretty much, this is how easy it is. It's shocking. We look at a property. If it has positive cash flow, and I can touch more on what they're looking for, but if it has positive cash flow, they lend to you. They don't look at your income. They don't look at your credit score. They don't look at none of that. They want a clean down payment, right? So they are avoiding money laundering and stuff like that. They are looking at that just like they do in Canada. But if the down payment is clean and the property has positive cash flow, and actually we can even do some with certain lenders if there's no cash flow. That's how aggressive they are over there. And then the property's yours, and you can rent and repeat. There's no limit. You can get unlimited properties doing this.
Wow. So, and when you said a clean deposit, understood that everything needs to be checked. Are we allowed to use Canadian borrowed funds?
Absolutely. Yep. They just want the source of the funds. So that's what I mean by clean, right? It can't come from anything, terrorist financing, drugs, like, you know what I mean? Money, it was under my mattress, like stuff like that doesn't work. They want the paper trail. The requirements are actually less than Canada though, because Canada wants a 90-day paper trail. They're looking for a 60-day paper trail in the States.
Okay.
So it does make it a little easier to prove that.
What about if an investor, we look at different strategies and we mention MTR, STR, and multifamily space. Do we have our choices for financing? Perhaps we find the property first and then seek financing. How is that opportunity in the US?
Yeah. So I'm going to say 1 to 4 units is the absolute easiest. Okay. When we first got set up in the States, fix and flips, new construction, and multifamily were the hardest. And I say were because we've solved that problem now. But everyone will do 1 to 4. Like there's so many lenders that do this. Okay. Now, what you do is you send in the property. So really they can send us the realtor.com or the Zillow link, because when you check that, it usually will list the property taxes and what the place can rent for. And then we enter that into the lender's portal and it will price the file. And then we can let the client know this property will have X price. And this would be the fee. Does this make sense to make the deal work? And it's very specific to even the zip code, because I had a client, we're working with him now. He's refinancing 2 properties in Florida and he wants 150 each on each home. It was just something he set in his head. So we priced them out, and one property is cheaper on the interest rate than the other property. So it's interesting to see how the lenders like different zip codes more than others. But it was only 0.25% difference. So it wasn't like a huge thing. But yeah, so that's what we do. We analyze the property. Now, if it's a fix and flip, right, they want to see the full quotes of the property. So we can now do this for foreign buyers. So initially we only had like private lending that would do this, but now we found some cheaper options. It was hard, but we got them. And so that we need the quotes on top of everything. And that's cool because they'll lend, depending on the lender, anywhere from 70% to 95, even 100 I've seen the odd time. 100% loan to value of the loan to cost. So for an example, let's say you bought a property for 100, you're putting in 50, and then it's going to be worth 200. We can potentially finance the full 200, again, depending on the client, the property, the deal, location. There's all these variables. So the client doesn't have to pay any money out of pocket. So it's super cool.
That is super cool.
Yeah.
Now, the US, it blows me away with the amount of information you can find out about a property using some programs and some software. Do these programs have these zip codes all down pat too? So you can say, a certain postal codes outside of the, favored banks type of post.
I'm not sure. They might. Primarily for me, right? I use the lender's tools because that's what they want, right? That's how we get the deal to them. So the lender's tools that I've seen, there's not like a way that you could search and see what zip codes might be the best. But it does allow us to see everything. It allows us to see, if they got a seller credit and they applied that as like a buy down to lower their rate. We can see what the buy down would be too, so we can let the client know at that point, because at that point, they're only sending us the listing. They haven't offered on the home. So then we can consult with them and say, hey, here's what you asked for from the seller as a credit, and then we'll lower your mortgage rate for you. There's just different cool things that we can do.
Different cool things, but that also sounded as you were really helping us and strategizing on what would be the best approach if we have the property first.
Absolutely. That is exactly what we're doing, because then we let the clients know, or we'll say, you know what, this one's not that great, right? And then they look for something else. So, but because it's property first, right, and not the borrower, we don't really, at this point, we don't need anything from the borrower. It's yeah,
Insane.
so
That's a different approach. You can just go shopping and try it, and then when the right one comes, then it's like, okay.
that's it.
Who wants to go? Let's go. Now, mortgages in the US are quite different than Canadian mortgages. Can you just explain some of the differences for the viewers, just so they get an idea of what to expect?
Yeah, so the first thing, there's a couple key differences, but the one thing that I think is super cool for investors is you can specify when you want your mortgage to be open. So by default, it's open after 5 years. Okay. But let's say that you think the rates are going to be lower in 2. So you can say, you know what? I want to get this mortgage, but I want to get it so it's open after 2 years. You can do that. Now your rate's going to be a little bit higher because you've done that. But then you can refinance and change lenders in 2 years, and there's no fees or penalties to do it. I mean, there's fees as far as title, right? Because over there they use a title company instead of a lawyer to
Right.
process the financing transaction. But there won't be any fees from the lender to break the mortgage. So that's super cool in and of itself. Even if you want to refinance, right? You could just do open right away. So say you're renovating a property and you want to pull your funds out, just do open from day one. Then when you refinance, you lock in, get your best rate, all that good stuff. So that's one thing that's huge, because in Canada, right, if you get a 5-year fixed, it's fixed for 5 years, right? And if you want the 1 year, so technically you could accomplish the same by getting the 1 year, because then it would be open after that. But if you go with the 1 year in Canada, your rate is going to go way higher. And in the States, it does go up, but not in proportion to what it does in Canada. So it's not so much of a difference to choose the shorter term. So that's one thing. The other thing is your term is your amortization over there.
Yeah.
That's something that Canadians have a hard time wrapping their head around, because they're like, well, when do I renew it? You don't. You don't. It's done when it's done.
Yeah, like your 20-year terms. I mean, 20-30-year terms for your mortgages,
Yeah.
and the rates fluctuate. The rates are a little bit more sensitive to market conditions, are they not?
Well, they are, but when you get a fix, let's say you're locked in. So if you get 7%, you're there the whole time.
Okay. Right.
Do you know what I mean? You can get an adjustable. So their adjustables are kind of like a hybrid of our fixed product, because they'll actually fix your interest rate for a period that you select. Usually it's like 5, 7, or 10 years. And then after that, every 6 months, it gets reviewed and adjusted based on the market.
Okay, so you're paying a little bit higher for that product as well but you're benefiting.
Potentially.
Yeah.
Yeah.
Cool. And what else? I mean, there's so many questions here. I'm trying to think. So we got 100%, up to 100% financing. They haven't gone.
Yeah.
They're not going over 100% anymore, though. But LT.
No, and that's only for fix and flips. So normally a Canadian, you can buy with 25 down, okay, but you're going to pay for it. So I think the sweet spot for interest rates is 30% down. But on fix and flips, that's where you can get away with it, because they're financing you based on the completed value and not necessarily the purchase price.
But they need to see the scope of work and what that quote entails as well, just to clarify. Yeah.
Yes.
Okay, and apartment buildings, do they fall under pretty much the same type of?
Yeah, so those are probably the hardest, because we have a strategy that we do. I'll share it with you here. But so a lot of Canadians, they have to find a US partner to buy a commercial building. So that was a problem when we first started lending, that we were facing. And the thing is maybe you don't want to partner. Do you know what I mean? Like maybe you can accomplish this yourself, or maybe you have enough partners that once you throw in one in the States, and I found when you're partnering with somebody in the States, just so you can get the deal, they have all the power, right? You could have 10 Canadians over here, but without that one US partner, you've got nothing previously. Okay. And we fixed that. And I'm gonna touch on that. But that's how most of the lenders work over there. So what we found is we did find some commercial lenders who will consider your Canadian investing experience, right? Because you don't have, so in commercial, they want to see the experience is really what's important. So we found some lenders that will give the Canadian investor the very first commercial mortgage over there. Okay. Now, once they have one commercial property over there, all the other lenders at that point, and I can't say all of them, but most of them will open up now, because now you're not a newbie in the States, you're established. So now you can get the really, really good low rates. And like we had a apartment building in Michigan, and it was priced around 6%, which was really good for an apartment building and for over there. Like it was a really good deal. So what we do, here's our strategy. So we get the client, it's the higher priced first time, mortgage. Then they buy their second property, and we do that with a good lender, like a really low price lender, really low fees. And as soon as that transaction happens, then we refinance the first one with that lender as well, because now they're not newbies. So then we get rid of that initial financing we set up for them. And then going forward, it's always the cheap financing after that.
That's a new strategy for us, right? And a good insight to have. You have the right.
Yeah, and then you don't need a US partner. That's why we found that, because getting that US partner has all the power. So then the deal didn't work, or if that partner was greedy, right? Then the deal wouldn't work. So we found a way through lender partnerships, right? So that way we don't need the US partner, and that helps.
I was expecting you to say high fees for that, but I think I heard you say it's low fees. So is it a high rate that the Canadian will have to pay for this initially?
Well, yeah, like on those, okay, that deal that was at 6%, you're looking probably 8 to 10.
Okay.
With the other lender, and the fees, they range from 1 to 2 with a good, commercial lender, and you're 2 to 4. I want to say probably around 3 though, but you're 2 to 4 if you're using this other lender. So you're definitely paying for it, but it's short-term pain for long-term gain. You're going to build the U.S. credit history right through your corporation. You're building that experience. And once you have that experience, then you never have to visit that financing again, right? You can get that lower price financing all the time, depending on the property, right? If it's a really weak property, then of course that higher cost financing is there for those riskier deals. But if it's a strong deal, then absolutely the lower price financing's there.
That's now, but my mind is going that I think we'll be having a conversation afterwards. Because again, it's about making the numbers work, right? And if you find the right property and the numbers will work at the higher lending rate, then it's worth it to build that portfolio.
That's right. And we get it all priced out first before we even offer on the home. We literally, so the lenders, they call it a pricer. So we submit the file, they price it, we present it to the investor, then they can run all their numbers. And if it works, great. And if it doesn't work, like it doesn't work, right? It's a numbers game. That's all it is.
This sounds really exciting. I really appreciate this, Scott. Now for you and LendCity, where do you guys, is there limits to where you're lending to in the States, or are you every state?
Well, yeah. So like every lender that we have does not actually cover every state. Okay. But with all of the lenders we have combined, we have all of the states. So meaning like the hot markets, you're going to find a lot more lenders there. than the slower markets.
Right on. Okay.
But mainly Canadians, I find they're doing, you know, obviously Florida is a hot one. Ohio, because it's cheap. A lot of people are getting in Texas. And actually, I think a lot of Canadians still like Arizona as well. We do see lots of people want Arizona.
Yeah,
And those are the hottest.
Carolinas have been mentioned a lot in some recent conversation as well. Have you seen much going on there or?
Not as far as investors, right? I think most of the investors, I think number one is probably well, I'm torn between Ohio, Texas, and Florida. Like those three, they all have different strategies, right? But those are the three hot markets that I see out of any of them. Not too much in Carolinas. South Carolina, they're going to charge you more property tax. I think it's like 4 times the tax when they find out it's an investment property. So they actually jack up the taxes. So that's a bit of a negative. So I do see more North Carolina than the South. But it's not that much. Like I don't see a ton of that.
Gotcha. All right. That's incredible. You've given us an amazing amount of information. I can't wait to have a conversation with you about this. For all of our viewers watching, Scott, how can they reach out to you?
Well, it's a couple things. So our website's at LendCity.ca. Through there, you can pretty much get everything. There's our social media, our private investors hub if you want to join and access webinars and just different trainings, because we have trainings on this in there as well. And then obviously we have a contact page on there. So they've got all of our numbers, emails, that good stuff. So that's it, just LendCity.ca.
Beautiful. And I know Irismar reached out to you because we saw you at a US investing retreat, and you did a great job on stage. That was the consensus of the entire room. So thank you very much for sharing your knowledge and sharing the value.
Thank you. I appreciate it. You know, 2-3 years ago, I never would have thought I'd be speaking on stages, and then I started to just force myself to do it, and yeah, I love it now.
Thank you for sharing that, because I don't think I would have guessed that.
Yeah, it was a fear. It was a fear, so I forced myself to do it. That's actually something I do. Like when I'm scared of something, I actually do it more on purpose because I don't want to be scared of things. And that's a perceived fear, right? That's not an actual fear, but I didn't like it, but now I love it. So thank you.
Good for you. Congratulations. We wish you all the success, and we can't wait to talk some business with you.
All right, sounds good. Likewise, thank you guys so much for having me on.
No, thank you, and thank you everyone. And if you want to reach out, go ahead, check out the page.
See you next week, Scott. You can hang out, and we'll see you next week, everyone, on